have this? Are you getting this? Yeah.
Okay, good afternoon, everybody. I don't know if there's an actual topic to this panel. I think it's something multifamily related, real estate related. Listening to the other panels, we'll try to pick up on where they left off, talk a little bit about the industry today. I would like it to be very relaxed. Everyone can talk over each other, argue a little bit. Some jokes are appreciated. If anyone at any point has something to say, just stand up and yell. It's always welcome. Okay, we'll start off by everybody introducing themselves. We'll start off on the far corner by Aaron, work our way around.
Hello, everyone. Oh, sorry.
Whoa, back up.
Sorry. Shine. Aaron Gorin, Cedar Grove Capital, owner, operator, multifamily, out of state.
That's it?
That's it. 5 towns. Hello, everyone.
Who are you married to?
Married to
Michael.
Michal, 7 kids.
You done?
Done. Now I'm done.
Michael Haas, Coney Management. We are a third-generation family office that owns and operates rent stabilized, we won't say it too loud, apartment buildings here in New York City. I don't know if any of you remember the time when rent stabilized buildings was a very exciting place to be, but that is where our focus is, and actually with all the excitement of the last panel, I actually think that this might be an opportunity to wade back in, but we'll leave that for a different time. As well as we have an industrial platform that owns and operates industrial warehouses in the Southeast. No, you're not on.
Adam.
Hello. Okay, there you go.
My name is Adam.
Adam Mermelstein, similarly to Michael, we have I guess not similarly, we have a project-based Section 8 portfolio that's on a nationwide basis, and similarly to Michael, we also have an industrial platform pretty much spanning the Northeast and part of the, I guess, like central South region, and we've played previously in the New York multifamily rent stabilized space with Shalom and Penny. Steven.
Yeah.
I forgot the crowd. Should have.
Yeah. Hello, Stuart Zelmanovitz, Yellowstone Property Group. We're a first-generation owner and operator of multifamily real estate, primarily now in the Midwest. We've worked our way all the way up to New England, up to New Hampshire, down to other markets, but now we're primarily buying and owning and operating in the Midwest, and there's not much more to know about us.
Well, then it will make a boring panel.
Yeah.
All right. Okay. I'm sure you guys have hopefully a little bit more to add than you did, and we'll hopefully get into a few different topics as we move along. Again, the crowd really is welcome. It's about you guys here today. I only have 1 or 2 things to say, and hoping the rest figures itself out. So if anyone else has anything to add at any point, please feel free. A lot of people are asking today, what's a good deal? Do you have a good deal? Any good deals out there? I don't even know what a good deal means today myself. I'd love to hear from the professionals and a lot of people that want to understand a little bit more about what a good deal is what is a good deal today? What exactly are you looking for, and how does that describe it being a good deal to you?
So
Aaron, we'll start with you one more time.
I think the simplest way to think about it is a good deal is one where you can actually achieve your business plan, right? So if you have a deal that you're in construction and you're doing ground up, that's probably a good deal for you. If you are someone who is an out-of-state owner of multifamily that has a third-party manager, probably going into a deep value-add strategy is a really bad idea. Unless you're planning on moving there, you're going to lose all your money. So a good deal is one where you can realistically tell yourself or your investors, okay, here's how I'm actually going to be able to achieve any of the things I'm telling you and how I'm going to get you out. I think the thing that I see in deals that are sent to me or that I tell other people my opinions on, which are generally very candid, is like, what's this guy's actual plan to take you out? Like, I know how he's getting in, how is he getting out? Right? And oftentimes you'd be amazed that there might not be a plan, and that's probably a bad idea. So I think a good deal, again, if you're in multifamily, if you're in industrial, it's always like, what's your actual core competency? For many people here, your best thing might be raising money and not operating the property, right? Which is for most people, their more difficult part of actually owning a property is actually running it. So if you can't run the property, you probably should not go into a heavy value add or a deep operationally intensive business plan because you can't actually do that. So you know, beyond that, the flavor of the day for different people is different things. You know, I prefer chaos and confusion. That's my thing. We have our own management company. We have minions all over the country that can get in there and do the thing with the thing. So we like operationally intensive deals. Many people don't want that. They want a clean deal that they can just chill and cash flow. So it depends on that. But simplistically, you have to be honest with yourself. I think the last year or two have taught people what they're actually good at. I think a lot of people here maybe didn't know what asset management was. You could just buy and sell and buy and sell. You didn't actually have to, you know, run the properties. So I think the last 6 to 9 months have been a bit of a, you know, how would you say it in English? You know, like a musser schmooze on a soul searching experience on what it means to actually run properties, especially if they're not near you. And I think that people are refining their ideas of what they can actually handle, et cetera, et cetera. And the Rebeach fears the Welt. So that's really the most important thing.
I don't know if we can add
Advise
to
the
that.
Jewish panel.
That's it.
I mean,
All right.
when you end with Rebeach Shalom, there's not much, you know, there's not to add to it. So I don't want to, you know, step on that part. It's for sure that's the case. But I think, from my own personal opinion, is that generally we run in herd mentalities. Herd mentalities, the way it works is, you see the guy down the block, he bought a building in Georgia, he tells everybody, and perhaps it's true, he refinanced all the money out, and all of a sudden all the money goes to Georgia. And then it goes to all these different places. And I think you have to bifurcate what was, how you value the deal in the past, and how you're looking at it going forward. Generally, we always only looked at value-add deals. And the reason was because the value-add protects you in the downside. Of course, in the beginning, if you're taking bridge loans, it's going to be, and certainly in this environment, you're opening yourself up to a certain level of risk. But the value-add protects you if the rents start flatlining, right? If the rents start flatlining and you're buying at 30, 40% below market, you're protected. If the rents don't grow 3% a year or 5% or 10%, or if in Miami 50%, that for some reason everybody thinks it's going to be every year 50%, then you all of a sudden going to hit an affordability issue. And when you reach an affordability issue, then all of a sudden your game plan and your business plan flies out the window. So we are very big believers in a value-add philosophy. We're also very big believers that, you know, to your question about opportunities, the way we look at it today is that you cannot paint the entire commercial real estate industry with one paintbrush. It's a disaster. New York City's ending. We're going underwater. Interest rates going to 12% forever. What ends up happening is, again, the herd mentality, the same way the herd mentality took you to buy deals, it's now taking you away from deals. And all of a sudden, you're not focusing on the opportunities. It comes into your inbox, you're not even paying attention to it. And so what I would caution everybody is that there's no such thing as looking at a deal and wasting your time. You're only going to become smarter. And if you're really flying low to the ground, like you said, managing it yourself, you're going to recognize which block, which opportunity, where the rent's really growing, where the rents are not growing. You know, just to go to New York City for a moment, you know, we have close to 2,000 units in Upper Manhattan, and the rental industry has never been this hot since I'm doing that. I'm doing this 20 plus years. By the time they're telling us to move out, we have it already rented. So there are dynamics going on that you may not know because you're not managing it yourself. And to your point about asset management, you know, in 2019, when the laws passed, all of a sudden, no different than what's happening in multifamily out of state, you had to learn how to manage. And ultimately, learning how to manage gives you a leg up in understanding your market. So to recap, where do the opportunities lie? They're diamonds in the rough. You have to be paying attention to the market, not just the financial market, but also the economic market, the macroeconomic. Everybody's talking about inflation. When you deal with inflation, you know, there's a very simple factor. I'm not a macroeconomic anything, but you just look at the M3. The M3, which is the money supply, went from 15 billion to $21.5 billion or trillion dollars in a span of a year and a half. So if it grows by 30, 40%, there's of course going to be inflation. And then the reverse happens as well. Right now, it's starting to drop. So we can't tell you the future. But what I could tell you is there are opportunities, and that everybody should keep their eyes open and look for those diamonds in the rough.
From my perspective, I would say that there are a few different components that make something a good deal. I would start by saying replacement cost. So from that perspective, you can always change, you can always manipulate the cap rate, you can raise the revenue, you can lower expenses, but the value on a per unit or per square foot basis is something that you'll never change. If you're buying a 100-unit building and you're paying $50,000, $60,000 a unit, whatever it is, that will never change unless you're able to create more units. If you're buying something on a cap rate basis, you can always change that both to the high and the low based upon the revenue expenses. So something that we look for is trying to enter into deals at below replacement cost, which is usually on a good price per square foot or good price per pound, good price per unit. The other component that I think we look for, which has sort of changed over the lifespan of my career, is what once was a game of musical chairs, let's say in New York City, where we would buy something that made no economic sense. We were buying at 2, 3, 4 caps at most. Financing, not making any money on the cash flow on the operations of the building, has now shifted to from my perspective, to I would say more of the classical real estate model, which is buying cash flowing buildings and making money on the operations of the building. So actually making distributions as opposed to making money on a terminal event, on a refinance, on a sale of the building. And one of the reasons, frankly, why we're less involved in residential than we once were is because of the hike in prices over the last, call it 5 years, maybe even 3 years, of residential pricing. So as residential has gone up, interest rates have gone up, cap rates have gone down. You're now at negative leverage pricing, and to me that doesn't make sense. On the other hand, when you're buying industrial, as an example, so we know it's very easy to tell where the cap rate is because you have a tenant in place, and as long as you're buying with an interest rate that's going to be lower in order to make the spread, you'll be cash flowing. So in my mind, that's a safe model, and exactly what Michael was saying, which is if you're buying a $3 rent in a $5 market, you know that if that tenant leaves and you still have to, and the rent goes down, I can still put in a new tenant instead of at $5, I can put him in at $4. So there's safety in the downside risk. I would say those three components are what make a good deal. But obviously, that's what we look for. But finding it is obviously a lot more difficult.
Right. A lot of interesting perspectives here. But I think that one of the things that people have to stop doing is using the word deal. Is it a good deal or is it not a good deal? I think what's going on in the market now and what people are experiencing and a lot of the negativity and a lot of the positivity or opportunities, everybody needs to stop talking about when am I getting my money out? How quickly is it taking? When's the refi? For the last few years, investors, frankly, have gotten spoiled rotten with the idea of a cash out refi. Something like that, or a quick sale. Oh, I made 6 times my money. They go to shul. They all come onto a panel together, and they kick the GP out, and the keys are flying all over. That's what's been going on now. But for the reality of everything is you have to stop thinking of these as deals, because what people have been doing have been speculating. They haven't been investing. And anybody who really understands what real estate is as a long-term wealth creator and an investment thesis of investing in real estate passively is that you need to be investing in these deals for the long term. You can't just look at a deal and say, oh, I'm going to flip it and make money on it. That's not how real estate has worked traditionally for the last few thousand years. It's a long game. Leverage has never really been a thing, and that's why it turned out like this. There's a lot of cheap debt, but really a lot of people that think they're investing are speculating. And when it comes down to, at least in our office, is that we don't care what somebody else is paying. We don't care if everybody's in Tuscaloosa, Homa, whatever, these made-up towns that nobody knows of, and like, oh, everybody's going there, and we can buy an amazing cap rate and flip it and whatever and chop it up and who knows what they're doing to these deals. We look at value. We look at inherent value, which means, like Michael was discussing, and what Adam and everybody else was discussing, was that we're looking at, are our rents lower than market? Do we have a margin of safety in these deals? Are we financing the deals for the long run, where we can know exactly what our predictable cash flows are going to be over the next few years? And then if the markets are great, phenomenal. We'll make all these capital events and everything will be awesome. But what it comes down to it is you have to be well capitalized. You have to have a margin of safety. You can't buy too high. But it has nothing to do with what everybody's doing. It has to do with, do you feel that this is a good deal, that you can make money with
You said deal.
with your I'm sorry. Where's the jar with the deal jar? But is this an investment? Is this an investment that we can have predictable cash flow over the next few years? I think that's really important. And you need, for us, really, it's basically Benjamin Graham's value investing thesis. Or do you have a margin of safety? Can we withstand and make cash flow over the course of the debt term, where we don't really need to make an equity multiple to pull our principal out, because we can pull out an average 10% cash on cash over 10 years, all of our money's out. And we don't have to rely on market whims and everything going on. Is there a margin of safety in operations? Is it a super duper hairy deal? I hate hairy deals. I don't want to be up in the middle of the night hearing about this is flying out the gasket and hearing new words
I
in
have
plumbing.
to offer a counterpoint here, because I think that it depends on where you're getting your money from. I think if you're a syndicator and you have investors and you have a pref, let's say it's 7, 8, 9, 10%, and you have your hurdles above certain things, you have to make as much money as possible as quickly as possible to make money as a GP. That's the truth. People say, oh, I'm a patient. No, you're not actually patient. You just are forced to be patient because you couldn't make it fast enough, like, ideally. So the way we would look at it is like, is this an investment or is this a trade? Right? Some people here dabble in stonks, right? Sometimes you're just going into the meme coin, you're going into the crypto thing. That is not an investment. Sometimes you actually have a fundamental view about a company or an industry and you're willing to hold for the long term. We look at properties, depending on where the property is, how new it is. Some of these properties need to be razed to the ground. The terminal value in some of these things is zero because the land is worth more than the property because it's been traded 3 times and no one fixed the roofs. And so now it needs so much money to keep it above the ground that the only value is usually for a builder to just destroy the property and build something new, or to get a tax break, or to do an opportunity zone, or some of these things. So I think, to my earlier point, it's like, what is your actual plan? Can you execute the plan? Is it like, am I going into a building that's built in the 40s, and I'm going to do a unit upgrade plan and not deal with like the horrible plumbing and the stav block electrical panels and all the garbage that no one did in the last 3 trades? That's a bad idea. If you're like, listen, the property's 40% occupied, my plan is simply to stabilize the property and get out. Either that's a refi, it's a sale, it's a whatever it is. I'm going to sell it to a nonprofit, and they're going to keep it affordable for 30 years. I'm going to get a HAP contract and put 100% HAP and sell it to a national whatever, HUD operator. There's multiple ways to get out, but you have to be honest at saying, this is not an investment. I'm going to take a bridge loan, I'm going to lever myself to the sky, and I'm going to get out after I execute this simple thing. People get delusional. They're like, oh, now that I've stabilized the property, I'm going to sit here and cash flow. You would cash flow, except now you have to fix all the roofs. So your cash flow is subsumed by, the money you have to dump into the property. So a hairy deal is only a problem if you delude yourself to think, oh, once I stabilize, I'm just going to hang out. I mean, the type of hair that's acceptable versus non-acceptable is different for everyone. I mean, we bought vacant buildings in unimaginable locations, but we paid $2 a door. So at $2 a door, I'm like, what are we talking about, right? I bought tax liens. I love divorces. You go into the divorce records, you find the wife. She's usually better. I don't want to sit next to him. You raid the stuff that you find the interesting things. $2 a door, it's fine. Yeah. So again, at that price, talking about basis and that kind of stuff, you have immense options. If you go into some of these cities or towns, sometimes if you find the worst property in the street, it's a blight. They will actually pay you to take it off their hands because no one touched it for 5, 10 years. So again, the theme is, it's the same idea, but meaning you have to have a plan. Is this a trade or is this an investment? An investment should be something that you can chill and have cash flow and give it to your kids. I wouldn't give any of these properties to my kids for the most part. They're horrible. But you can trade and you can structure the deal appropriately that it can be lucrative for yourself, for your investors, for everyone, provided you execute your own plan.
All right, everything was good till $2 a door because brokers don't make money at $2 a door. All right, let's bring it back for 1 second. Now that I think you guys answered everything on the list, we'll just try to, Adam actually said 2 words that stuck in my head. He said negative leverage, which is probably I hear on every single phone call today, the few that I made in the last few months. I'm joking. It seems to be a trend, I guess. It used to be easy, bridge money, under leverage is easy because you're taking out bridge money, you hope for the best, and you refinance.
Say it loud to him.
Right, he doesn't like deals. He likes, what's the word? What do you use
Investments.
today? Investments. New word. So, well, it's an old word. But going back on negative leverage, I'm just curious how you, we'll stick to multifamily for now. I know we'll jump into industrial a little bit with you guys later. But on multifamily, how do you view leverage today? Now that you're not taking out bridge money, you're taking out probably Fannie, Freddie, or a local savings bank, depending on where you're buying, whether it's New York or out. But how do you view negative leverage? How do you buy a deal today someone came over to me before, and he's like, I have a 6 cap. He's like, I can't believe it. I said, that's great, you're borrowing at 6, what are you doing with it? So at the end of the day, where do you go? So what does a cap rate need to be against where our rate is in order to make sense?
Want to jump in?
They shut your mic off.
shut me off.
You're over the limit.
It happens at home also. Yeah, I mean, I love zero caps, right? I don't want any cash flow. I don't want the seller to think he has anything. I want him to be like, listen, I'm 30% occupied. I'm bleeding out. Come for me. And then I look to see when is his loan mature. I look to see who his lender is. I call up the lender. I say, what's with this loan? Oftentimes it's the same lenders that have tons of these things. They say, oh, our loan's good. We're fine. I'm like, really? Because you're not. But anyway, so.
You usually break the divorce news to the lender also?
Yeah, well, no, usually they're already on top of it. No, I mean, okay, so again, if you're going into chaos, the cap rate is like the least of it. It's more like the basis, right? Like, because you're not buying any cash flow because it's in trouble. So you're looking at like, okay, what's my stabilized yield? I guess that would be the way to look at it. What's my year 2, year 3? How do you capitalize for that? Again, depending on how you're capitalized, you can either again, people don't like this, but I think it's the best way. You take a bridge loan, you lever to the sky, and you raise a ton more equity, and you tell your people, listen, we are going to be losing money for the first 2 years. We have an interest reserve with our lender that they'll pay off their own loan. Even if you're paying 8, 9, 10% on your debt, which is what you're going to pay, or 10 or 11. Again, this rubs against the old school mentality of like, I don't want to pay that much money. You have to look at it like a total return. If I'm borrowing at 10, 11, 12, and I'm going into chaos, you're probably thinking you're going to make at least a 20 IRR, right? So your cost of your debt is still cheaper than the cost of your equity, or at least it should be, right? So as long as you can clear the cost of your debt and carry the mortgage to the end of your business plan, your stabilized cap rate will be what gets you out, right? If you can get it to an 8 or a 9 as stabilized, even if you're borrowing at a 6, you'll still hit your 125,
What
130.
is a stabilized cap rate?
When you,
In
again,
2023.
It's the cap rate when you stabilize the property. There's no specific.
Of course, but what are we putting on a pro forma now?
it depends where the property is. Like we own in good places like Nashville and Charlotte and Raleigh-Durham, places you'd go at night. We own in horrible places. And the horrible places, you think you're getting a deal at like a 7, 8, but the market trades for a 7 or an 8, so you should be at a 10. And in Charlotte, we own a nice property in downtown Charlotte. Like people would line up for a 6, right? The deals right now are trading in the 5s still. Again, Nashville a little bit higher, Raleigh, Atlanta, different parts of Atlanta have different things.
Let me bring it to these guys for a second. It's a little bit easier to go cap rate to price. You two in the middle are both still somewhat New York. I know Adam took a big step back. He, I don't want to say saw a little foresight and pretty much got rid of his New York package before the storm. Maishi's been doing this, like you said, 3rd generation. You're still probably one of the more bullish guys in New York today. And Adam, we did a very nice sized deal in Williamsburg last year also, so during the tougher times. Like, what's the cap rate that you need to buy versus the leverage today in order for it to make sense in a rent-stabilized world?
So I just want to, make a little shalom between these two guys.
No, it's better.
It's for the views, it's for the clicks.
We practiced this. What do you mean?
I think that really the terminology is what's your cost of capital? Can it stomach what you're doing or not? Let's take it, from a GP perspective, I always hear this terminology is, like I want to sleep at night, or it's getting too difficult, and it's hairy, and it's chaos. In the last panel that talked about emotion, we find very, very much that a lot of the investments are based on emotion and a little bit less based on, logic. And I think we just need to bring them a little closer together. And really, ultimately, what it comes down to is what is your cost of capital? If the cost of capital can do what you're saying, then that's great because your basis is very low and your downside risk is that basis, that terminal value. And if your cost of capital can't do that, then you're not going to do that. So it really comes down to what your cost of capital is. In terms of where we see New York City, I want to touch on the point of the bullishness. You have right now in New York City a very interesting phenomenon that's going on. I always say that the way to look at anything is to follow the breadcrumbs. Like only a 3-year-old will tell you what he really feels. Like he's angry, he's upset, he cries. Over here, we got to read the breadcrumbs. In 2016, we did not read the breadcrumbs. What happened? In 2016, all of a sudden it came out that they're not allowing you to raise the annual increases, the regular RGB. And we all poo-pooed it and said, listen, we don't care about that. We care about the vacancy. As long as I have the vacancy allowance, I'm golden. But we didn't realize is that that's where it was heading. If we would have followed it, looking back, we have the benefit of hindsight. We get to take a step back and say, okay, where did I miss it? We missed it at the time in 2016, 3 years earlier. So now if you play the same tape over again, in June, the City Council and the Senate were this close to passing a law that would have allowed us to increase the vacancy allowance. Now, 3 years ago, I sat in an office. I mean, I think maybe Shalom, you were with us, Stephen, whatever. We were in this office and we were strategizing how we're gonna advocate. And I still remember getting a call. It was the Thursday before Shavuos, how Governor Cuomo is not going to sign the bill and we have nothing to worry about. And then after Shavuos, we got the news. And basically, we missed the signs. Like I said earlier, I feel like many times we travel in herds. And what's happening right now is there feels like...
Did you buy the deal?
I'm sorry?
Did you buy that deal?
We don't talk about deals. We only talk about investments. The point is that right now you have a generational opportunity. You obviously need the cost of capital to make it work. But we're talking about 20, 30 IRRs, and you don't need the laws to change that much. And you don't need everything to be perfect. The problem that we had in 2016 is that you needed to be perfect. You needed to be perfect. Everything needed to line up because you're buying 3 and 4 caps. If you're buying 3 and 4 caps, you need everything to line up. No different than any asset class. Once out of state dropped to 4 caps, you didn't have to be a genius to figure out that you needed perfection. One item off, you're toast. And so now you have a confluence of events. You have the financial markets, you have the economic markets, you have the expenses, and everything is just coming at you at once. So just to go back for a second, we would never do a deal that's negative leverage in a stabilized New York City asset. You can't afford to do it. You have to be able to buy a 7, 8 cap today in a 6% market. You need to be able to raise your rents 3 to 5%. There needs to be an MCI. There needs to be a story in there for you to make it work. But if you could make it work, you will have a generational opportunity that you won't see again. $100,000, $110,000 a door, inflationary numbers. I mean, I probably have to go back 20 years. 50, 60 a door. Again, Brooklyn. We're not talking Bronx. I don't know Bronx. I know Brooklyn. I know Upper Manhattan. You have to go back 20 years. So right now, it just feels like that the opportunity is there. The winds of change are coming. I don't know how long it'll be, but if you don't need perfection and you're protecting your downside risk, you have a very good opportunity. So to come back, long-winded answer, we would not buy negative leverage.
For me, this is all a game of opportunity. So I look at this and I want to do real estate because I think it makes a lot of money. If it doesn't make a lot of money, I'll open a pizza shop. I'll open a conference. I'll do whatever it is.
Conference. I think he wants to do Ecor.
Yeah, Ecor or Rebeach. No, anyone.
He doesn't see
Maybe I'll open
deals,
a
I don't
third
say
one.
Ecor.
Yeah. No, the point is, I think that one of the reasons why we're out of the residential game is because I don't see opportunities to make money. I see no way that you can buy a negatively leveraged deal and make money and make any money on a long-term basis. So, for us, we've entered the industrial market, which is much easier to understand the metrics and understand where the rent is, where the expenses are, where your debt is, and to understand where your cash flow is going to be in a year, 2 or 3 years.
But you also have a huge project-based HUD around the country. So how does that differ when you're buying a deal like that?
Same thing. I haven't bought a project-based Section 8 deal probably since 2019. We were buying from 2009 to 2019 at upwards of 10 caps early on, and they probably went down to 6 caps. but they were always cash flow positive and they were always positively leveraged deals. Um, the only negatively leveraged deal that I would go into is, similar to what Aaron was saying. When you're buying a deal that's 30% occupied and there's a clear path to get to, a higher cap rate and refinance your cash out, so then I would do that. But just to buy a deal where I can hope, like when a broker calls me up or when you call me up and say, you can, you don't do this, Phil does, but when a broker calls me up and says, you can take this deal from a 5 cap to a 6.5 cap, that's of no interest to me. So if I can take it from a 5 cap to a 9 cap, I'm interested, but less than that, I'd rather invest in another area.
Stuart, anything to add?
Yeah, I would say staying away from imagining what might be in the future is a very smart thing. That's just an important thing. You have to focus on predictable cash flow if you want to maintain a portfolio of healthy assets. The problem with a business plan like yours, while you might make a lot of money, you need to be very diversified, because the one deal that's going to show up at a bad time, or not you, somebody in a similar situation, the one deal that's going to have the loan expiring at the wrong time it's detrimental, and it's a wipeout move. So you have to be completely diversified if you want to maintain that as a scalable business model. For us, the most important thing always was positive leverage day one. We've been buying with Fannie Mae debt since 2017, basically. So you can make money on value-add deals that way. You can raise the money as equity. I know it's foreign to a lot of people. You don't have to borrow CapEx from the bank. You can put it in as equity. You can actually perform the CapEx needed, and like you were saying, follow through with your business plan. And in the right market, again, assuming you structure the debt in the right way where you don't have such a prohibitive yield maintenance structure, you can get out and make a lot of money at the right time. And it's, instead of timing the market or pretending what might be in the future, rates are going down, they're not. I don't need to focus on that if I'm focused on the inherent value of the mark of where the rents are today versus where they could be. So I think for us, that's just been a winning strategy. Baruch Hashem, it's worked. And I don't have to really worry about floating rate environments or things like that. And I think it might make sense, even if you don't want to do that on your full portfolio, it might make sense that one of your strategies should be a long-term cash flow value add strategy in markets that you want to be in.
Let's go on to sourcing deals. Any investments? Any other than a really good broker? Any way in today's market, other than this guy's going through divorce papers, but is there any, call it, other way that you guys are sourcing deals today differently, that the market is that it is now, trying to look for an opportunity?
Tax liens.
Tax liens?
Tax liens is amazing. The issue is you have to go to court. You have to go to court. Not every county is online, so you have to hire up your people and dispatch them to the courthouses and physically bid in person on tax liens in some counties. These are tax liens meaning someone didn't pay the taxes. So these are often properties that don't have a lender, or they were in foreclosure or something happened. They don't have any, you're super senior to everyone else. So you can get something for nothing, and sometimes you can even get nuisance payments. Like we had a property that, unbeknownst to me, someone bought the land under the lake. We had a lake on the property. Apparently that was a separate tax parcel. No one ever picked it up. Even our lender didn't pick it up because it was a lake. Some guy bought it for $20, and he came to us. He said, "You're using our lake. You're fishing on it. You owe me, $1 million." And I was like, kudos to you. I like this guy. And I figured out how he did it, and I was like, I paid him $1,000. I was like, go away. But I was like, I need to do that. That's a good idea. So tax liens would be a differentiated idea. I said the divorce papers. Obviously, loan maturities. That's an easy one, right? If a loan is maturing, likely they have to do something of some kind. And then again, depending on how esoteric you want to get, DIP, bankruptcies, debtor in possession financing is very, very lucrative. Again, just going into the craziness, you have to understand how much you want to be busy with lawyers, right? Depending on how the deal's coming in, you might need lawyers. If you're going into notes, foreclosures, mezz, that kind of stuff, you need legal. But good broker is the most important thing, right? Someone that won't lie to you too much, and will tell you, okay, like this is the deal, this is the real price, this is the actual what's going on. There was a shooting yesterday, and there was a shooting the day before. We'll just tell you that now. And by the way, the borrower changed his name. By the way, that you're like, okay, I can deal with that. What you can't deal with usually is surprises, right? So when you get surprised later on, that's when deals tend to be more difficult. If someone just tells you the first day, like, here's everything bad, all these units are down, this is that, you're like, okay, I'm gonna underwrite for it and offer based on what's gonna end up getting discovered anyway. Like everything always comes out. Just if it comes out later on, everyone gets angry. If it comes out up front, it might not be the deal for you. So I would still say broker number one, but depending on how much you want to be busy with databases, the governments have an incredible amount of public data, between these divorces and liens and everything. You can get a lot of information from just trolling these records. Get a nice guy from India to scrape the data for you, or the Philippines. Just pull it in and siphon.
I don't know that I can add to what he said. The one thing I will tell you is that everybody talks about having a good broker. I want to share with you how to develop these broker relationships.
They
Right?
never bought me anything.
Right, exactly. I never bought him anything. The point
And now
is,
you know.
in my humble opinion, when you're dealing in New York City, thank you. In New York City, it's a little bit easier, right? We all know each other. We'll meet each other. It's very easy to connect to the brokers. What happens if you go out of state? Let's say we do industrial out of a state. And many times people are lost. I don't know where to begin. Not everybody is intuitive with the tax liens or divorce papers or death certificates or tombstones, whatever it is that you're looking for. What I have found is that responsiveness and what you say is what you do. You understand? If you have those two things, any broker will want to do business with you. You could be the youngest guy in the block. It doesn't make a difference. I remember, I just want to share with you, 20 years ago when I first started in the business, and our family had taken a hiatus from buying real estate. Back then, when we were talking about gross rate multipliers, back then they were trading at 4 and 5 times the rent. And the market started to take off. This was back in 2001, 2002. And all of a sudden, it was 7 times the rent. And like, oh my God, 7 times the rent, we're going to lose money, the world's ending, does it sound familiar? And I wanted to get started. So what did I do? So back then, before there was Google, right? I don't know if you remember white pages. I'm 48, so don't look at me like I'm funny, okay? So I printed out white pages. I printed out 1,000 brokers. I called every single one, introduced myself. Family hadn't bought in a long time. No one really knew who we were. And I contacted each one. I developed a relationship with each one. And finally, 6 months, 9 months later, I got my first deal. And it was a grand slam of a deal. Now, what did I do differently than the next guy? The answer is because I lived it, I wanted it, and I communicated. And if you do that, that's how you create these broker relationships. They want somebody who's going to close, right? You don't want to do business and he backs out and he changes, etc. So while kudos to Aaron for all his innovative ideas, we're much more, we love brokers, especially the ones that we have wonderful relationships with, and new ones that we develop. And I think that for anybody that's starting out or anybody that's already in business, don't become tired. So many of us become tired. It's like it's difficult and it's a grind. You wake up in the morning, you start your day early, and you're focused, and you will see success.
I mean, that was like a Tony Robbins speech. I don't have anything. That was good.
It's great. Push-ups. Push-ups, right?
Push-ups.
Yeah,
Let's go, right?
I leave it for the guys without socks.
No, that's fine. I was going to defer to you, because I've been watching your hair over the last many years. One of the best heads of hair in the business, I have to say. And
Greatest
and
beards,
Adam
best
walks
heads
in
of
with a
hair. We chose
yarmulke
well
like this,
today.
and I'm out.
Yeah.
I want to move on to a different topic that a couple of people brought up today when I was walking around is, without specifics of anything, is transparency. We're dealing with a lot when you enter a market of highs and lows. Usually the lows, some secrets usually come out of the office. And some paperwork comes out and numbers aren't always what everyone thinks they are, and investors are coming after their partners and trying to open up the books more. I'm just curious from a transparency standpoint, is there anything that you guys do differently today? Are investors asking for better reporting, different reporting? Do you guys audit your books? Transparency-wise, I know you guys happen to have excellent reputations, unless I would not have brought this up. But just from a transparency standpoint, have you guys changed the way you guys give over anything to your investors?
every once in a while when reporting comes out, I sit with my partner in the office, and I sometimes write into the reporting, and I handle it all myself because I need to understand the numbers and portray that information accurately. But a lot of times I'll stick in, by the way, this is a risk factor. And the question is, as the deal develops, certain risks develop in the deal. It's not just from the OM and everything closes and everything's great for the end of time, and then you'll hear about it when there's a disaster. But even when a deal is performing well, I think it might be a smart idea to bring up, hey, look, insurance is up. Our next year, we had a claim this year. Things might be going up next year, and just even being open about, just completely open about these type of things it just continues to build the trust that you had from day one when you went into partnership with your investors. I think it's a smart thing.
Yeah, I agree. I think bad news is always hard to deliver. Certainly questionable news is hard to deliver. Good news is always great. But I think the ability to deliver clear, concise messages, whether they're good, bad, or somewhere in between, is extremely important. I think investors appreciate being told in advance as opposed to being told after. And I think having clear reporting where they can view everything, whether it's online or monthly reports, is extremely important. Of course, with the caveat and understanding that there's always room to grow in this area.
I would just add that, when we look at the environment today versus, let's say, 2008, when, again, all the money was getting sucked out of the system, people were petrified, they didn't know how they're going to refinance their loans, etc. You always have this sense of, I don't know, for me, my biggest pet peeve is when people ghost you. You ever get ghosted? They don't answer the phone, you can't get in touch with them, they're flying to Israel, Rochelle, wherever they're going. I don't understand the concept of not picking up your phone. You pick up your phone and you talk to them. You know how many difficult conversations I've had to have after 2019? Someone said to me a very good differentiation. There's pilot error and there's mechanical error, right? 2019 is not pilot error. No one had any idea. It's a mechanical error. So pick up the phone and tell that to your investor. Guess what? We can't increase vacancy. Your top line's not growing. So guess what happens? If your expenses are growing and your top line's not growing, we're going to do everything in our power to, what's the phrase today? Stay alive to 25? Is that the famous? Right now.
Year 25?
That's what they're saying.
All right.
I like that.
So what you have right now is, obviously what they're saying is true. You send out reports, etc. But pick up the phone when they call you. Talk to them. That's the most effective way to communicate.
Agree.
All right, guys, as we wrap up over here, we would love to take a couple of questions from out there, if there are any, for anyone up here. Don't be shy. Anybody?
I thought we were going to invite Hashem up onto the panel.
Who?
Hashem.
He's going back to the Hashem.
Yeah.
All right, no one has anything to say. Well then, wait. So okay, they want to ask more about the industrial. I know that Adam and Michael over here took the dive from multifamily into industrial a couple of years ago. By the way, if it's too long, everyone can feel free as soon as you want to leave. But I know that you guys took the dive into the industrial lately, and how did that go? Do you see a difference in it? How's that business model going? Adam, I'll start with you and then go to Michael.
Sure. It's a pretty stupid man's game. It's 4 walls, a floor, and a roof. And you have a tenant, and there's not a lot of chachma to it. It's just a matter of if the rent is higher than the expenses and you can pay your mortgage and still make money. It's a lot about location. In my opinion, it's a lot less management intensive and it's a lot easier of a game. That's good.
So I'll just, it sounds like the crowd is getting a little restless, so I'll just make this really quick.
Guys, no problem if you want to
No
leave.
problem.
Just leave. That's all.
One of the reasons why we did not go multifamily out of state is because we believe very much in the management aspect of our business. And the reason why we pivoted to industrial was because the day-to-day management is extremely different. And therefore, you're more asset managing or leasing management. It's a very different industry. The industrial sector itself, you have everybody saying, I'm running into industrial. They show me a 7 cap, 8 cap, and they don't understand that they're going to tertiary markets. You understand? You're buying the building. You're not buying the tenant. So you can show me the greatest tenant, but he's in a tertiary location. The guy vacates. What are you doing? So just to
Yeah, you back up.
just to go back, just to go back, it's a great place to go. Just make sure you have the investment focus to stay disciplined and not to just do an industrial deal.
Anything else? Whoa, 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 wrong panel. The retail panel's tomorrow. There's no one up here that can help you.
Stay alive to 25.
All right, anything else or we're done?
Yeah, who's going to win this
All
color
right,
war?
thank you everybody for coming. Enjoy the rest of your program.